and welcome into the last Freightonomics of 2024.
It's crazy.
Wow, what a year. What a last couple of months of the year. Zach Strickland, head of Freight Market Intelligence, Tony Mulvey, senior analyst here. And, hopefully we'll have Dr. Zac Rogers on here a little bit later to call in and talk about the latest LMI and what that means for the forward look. And he is here, so good. So we'll have the forward look, for the rest of this year. And, of course, more importantly, what's happening in 2025.
Yeah, I think at this point of the year, everybody's looking to 2025. They kind of the hay is in the barn, so to speak, for 2024. I mean, obviously, we've got 3 weeks left of the year, really, and what happens here is kind of impactful to 2025. But I think everybody's more of what's to come, not what is. And we're going to talk about it a little later on a market expert look back at 2024 and kind of set the stage for 2025. But I think where we're at the moment is pretty interesting when you start looking at where we're headed.
Yeah, I mean, we're at that point of the year right now where everybody's kind of scrambling to get out the door. It's like one of my favorite memes, and I should have put it on the show here today, but let's circle back on that until January. Yeah. Let's put a pin in that and circle back in January. Probably one of the most common phrases, as a lot of people are really just trying to get out the door for Christmas.
Yeah, I mean, when you think about it, you really got, call it 11 business days until the holiday season really starts. I mean, it's not that long, and people are going to push projects. And really, if you're making decisions now, you're making decisions for 2025. Yeah. You're not making, outside of your short-term, day-to-day decisions, like longer strategic decisions are 2025 and kind of what's that look like, especially in the first half.
Yeah, you're finalizing budgets. Yeah. You're making sure that everything is tightened up to make as much revenue as possible, especially from the retail standpoint. Mm-hmm. A lot of fiscal years ending, so that's why this time of year is really not that productive from the standpoint of day-to-day office interaction. It is really about closing the year and prepping for 2025, and hopefully we can provide some insight on that a little bit later. But first off, before we get into Dr. Zac Rogers, and I've got two little stories that I want to hit on.
But we need to hit the market in two first and set the stage. So Zach, I'll count you in 3, 2, 1.
All right. First off, what other chart would I lead off the last show of the year with? But the outbound tender rejection index, of course, the white line being the current year. We're dipping down a little bit. Normal post-Thanksgiving feast nap time for the O-Tri, as I think I saw it written the other day on our daily watch. A little bit of a dip here coming down out of the holiday peak. Expect that to, of course, spike up. I don't know that we're going to get all the way back up to where we were in 2019, which is that orange line, the last year before COVID kind of changed the environment a little bit. But I do think we will tighten meaningfully. I'm thinking a 10% at least this time around Christmas. But I think the big lesson here is year over year, we're tighter than we were last year. You can see that pink line last year. It's not even really close. Like, even though I know the difference between 4 and 6% is not that huge numerically, it is a big deal for the overall market. Let's break it down further with the next chart, looking at the van, refrigerated, and flatbed tender rejection indices. If you look at the white line, that is the van market. That represents the majority of the freight moving in the United States. It is a much smoother upward trend line here. It is not a spiking, volatile thing. If you look at the refrigerated line, there in green, it's very volatile, much more erratic. Flatbed, same situation, and we're not even in flatbed season. That's actually a pretty decent little upstream indicator on something we'll hopefully talk to Dr. Zac Rogers about in here in a minute, that things are a little bit more percolating in some of these more niche areas, more niche markets. Of course, Christmas tree season helping to influence that refrigerated tender rejection index. Let's look at the spot rates in our next chart. The NTI, which measures spot rates, including fuel, and the NTIL excluding. Big differentiation here. We're seeing spot rates spike. We're seeing that if you remove fuel, they're actually way up year over year. And I want to throw one last chart, the NTIL seasonality on here before we end it. If you look here, year over year, excluding fuel, spot rates are exceeding 2022.
That's impressive. I think what was interesting is if you look at rejection rates, and I actually want to pull that chart back up because I think there's something interesting in it that I don't know if it's been noticed. I think if you look at 2019, it was far more volatile in terms of increases and like the changes,
Yeah.
this has been a pretty steady increase, right? And I wonder if that's like the takeaway of showing like how the market is in transition versus like the more erratic behaviors that we saw, call it in 2019. Like, yeah, we're not at those levels, but you haven't seen like the sharp increases or sharp decreases that you saw in some of this period where you saw upward movement. I think it's just more about the steady trend line higher, and I think that to me stands out more so that it's a actual shift in the market as opposed to a season. I mean, there's seasonal impacts to it, but I do think it's more of an underlying change in the fundamental change in the market as opposed to just seasonal.
1000%. I think this is a far healthier trend line. Now, we didn't have this data in the before times,
Yeah.
where we could see these slow, gradual crawls. I think if we would have had this data back in 2017, we would have seen something similar before all of the stuff kind of like broke the market apart. Because that's what happens is things don't just turn overnight necessarily, but you tend to feel them that way.
Yeah, and I think it trends into this, and then you get some outside influence that really outweighs, has the impact. Yeah. So I think it's one of those things. It's interesting. I think if you were to talk to a shipper right now, like they're not really feeling it. I do think if you looked at, I mean, the LMI is a prime example. I mean, you look at transportation capacity, it shows it was in expansion, right? And you see rejections, it tells you the market's somewhat tightening. But I think what it is, and these were conversations I heard at like CSCMP Edge earlier this year, they want to see the market grow, call it 2-3%. Well, you'll lose capacity in that moment. It works into a more balanced, easier to feel environment, but it sets up the market to be disrupted faster by any significant demand changes, things like that. It leaves the exposure is a lot greater to rapid changes.
Yeah, I think that's where we're getting to, is a more sensitive environment. I want to hit on two stories. One from Todd Maiden talking about LTL stocks sag on Q4 updates. We've got this kind of divergent experience in the LTL market. I came from LTL, so of course I love talking about it. So you're going to get to hear about it, and you're going to sit there and you're going to like it, whether you like it or not, for the next minute or so. But most of the LTL, the big publicly traded LTL companies, come out with reports that talk about how they're doing. A lot of tonnage down, Saia the exception here, but we've got some new data around this LTL market, and I want to pull up this chart talking about basically a pricing directional trend line change. And I've got this in white over the top of the truckload van contract rate. And you can see there is this is the last 5 years. So you see COVID, blowing up, exploding rates for both LTL and truckload. And then you see there this big percolation in the middle of last year for LTL. Yellow exited. Yep. And then in October, we had the Estes issue with the outage there that also kind of helped destabilize the LTL environment, which has far less carriers and is a lot less fungible than the truckload space itself. The truckload market, of course, remained relatively flat in that period of time. The yellow bubble, as I call it on this chart, and that's something I think we're seeing from a year-over-year decline in a lot of these tonnages. And I think if you're looking at these stocks, you have to keep in mind this is year-over-year. Last year was a very different space for LTL, and all they did was return to trend.
Yeah, and I think that's the challenge for the public companies is, right, they have to talk about things on a year-over-year basis. And really, for them, I mean, right now, you're probably better off looking at it on a quarter-over-quarter basis because, I mean, at the end of the day, that will basically set up how the environment has changed or is changing in the current state. Because again, you mentioned it, yellow exited this time last third quarter last year. Fourth quarter had impacts.
Took a while to kind of inject.
You're still feeling the impacts, and I think that's where the comps. I mean, if you listen to anybody, they should be telling you comps are challenging for LTL carriers in the third, fourth, even probably in the first quarter of next year. But then you start getting in second, third quarter, you're going to see a lot of those comps, I don't want to say ease, But the challenges that
It'll
they're going to
smooth
face right now, you're
can see it.
smoothing out that.
All they're doing is returning to the trend line they would have been at. So it looks like most of that yellow has kind of flushed out, and it looks like it may flatten.
And it goes to, I mean, truckload carriers are different, right?
Yeah.
I mean, I looked at Knight Swift third quarter. I mean, they were down year over year, but you start looking at revenue per loaded mile. I mean, it was slightly higher in the third quarter than the second quarter. It's like, these are the signs. As we're in this state of transition, you need to look on the shorter time frame than the longer time frame. The challenge is these public companies are held to that year over year number, and that's the biggest challenge, I would say,
it's
to
hard.
face for the executive teams at the LTL carriers.
Dude, I mean, we do ourselves a disservice by holding people accountable to such near-term timelines at times, especially with the stock market. Obviously, our 401ks love it, but it's not necessarily long-term health-oriented, a lot of these reports and things. But I think if we can hold strong, that will wash itself out. It is just temporary. The last thing I want to get to before getting to Dr. Rogers here, as I forgot to talk about my Christmas attire here, Tony. You know, maybe Dr. Z will like this festive spirit, but you know who's not feeling the festive spirit is a lot of operators in the trucking environment. Capacity continues to be an issue. A lot of people exiting right now. And the BMO report that John Kingston writes about, credit position of BMO's transportation clients worsen in the fourth quarter. The key takeaway here, if we can pull up the chart that Mr. Kingston loves to put in here, this is the former Bank of Montreal. A lot of carriers in North America, not just Canada, included here. But that blue bar you're looking at that has grown exponentially over the last year, and it grew even more so from Q3 to Q4, is bad debt allowances. So this is the expectation that this is impaired loans that they have lent to carriers, and they don't expect to get any money back from it.
I mean, to me, that's the sign of everybody's like, oh, capacity, like you're seeing, you know, net authorities, you know, flatten out, and like, to me, it shows like even if you have a good peak season, like it's not going to be enough to boost some of these operators. Like I don't say winding down operations, but they have to be, they're in that mode that it's, you know, the writing's kind of on the wall. It's just a matter of when.
And this is the bank, mind you. This is the bank that it's basically saying, like, we're coming to the end of our ability to extend the life of this loan. We don't foresee things changing fast enough.
This is where they start not getting payments, right? Like we've talked about it. Banks don't want to be in equipment sales. They don't want to take ownership of assets to some degree. As long as they have something coming in, they're getting to the point where nothing's coming in.
And for full context, the gross impairment in peak COVID, was 10 million. We're now at 464.
It's crazy. I mean, it's crazy. I mean, you're up, what? Call it more than two times where we were this time last year. I think that's how
capacity's still leaving.
And it will for some period of time.
For several months now. So let's bring on the man with the plan, the LMI author. Hopefully, you know, he's in the spirit as well as I am. Tony, you chose not to be in the Christmas spirit.
You know, I had it in the car and I opted against it. Maybe I'll have to go pull it out after this.
All right, I'll take that on right now. Let's bring on Dr. Rogers, Colorado State Associate Professor of Supply Chain. There he is. And look at that green sweater.
Nice.
That's gorgeous.
I'm ready. You know, I'll be honest. I didn't have this on at the beginning of the show, but we keep sweaters right here, and I thought, well, if all Zacs are doing it, then I don't want to be the one left behind. So, happy holidays,
inspire
everybody.
the spirit.
I love it. I love it.
Nice.
Yeah, Tony, you're a bit of a Scrooge, and I think that's fine. I think it's good to have different characters on the show, and not everybody has to be excited about the end of the year. That's fine.
Well, I was adamant about not putting a Christmas tree up until after Thanksgiving. So my fiance would tell you I am a Scrooge. So,
I'm a post Thanksgivinger myself.
Yeah,
Dr. Z.
Well, I got to tell you what's not saying bah humbug, boys, and that's the freight market. Things are looking good in the overall logistics index in November, which I imagine was going to be the first question. And so if we look at the overall index this month, we were up to there you go right there. We were up to a 58.4. Now that's slightly slowed down from the 58.9 that we had in October. And October was the highest level we'd had in about 2 years. But it shows remarkable consistency, and it's driven by what you guys just put up there, movements in inventory. We are seeing, and this I think really goes nicely with the moderation stuff that you all were talking about at the top of the show. We've seen good moderation, I think, sort of slow, steady growth throughout supply chains. Because remember, any number above 50, 56, even though it's a little down from maybe where we were last month or the month before, that is a healthy rate of growth for inventories. And what's really interesting is we're seeing. Sorry if I'm making noise. There's actually a bell on this sweater. You can, but I'll ring it when something exciting happens. But if you look at the split this month between upstream and downstream inventories, really, what it tells you is a story of good, solid seasonality and movements that should make, I think, carriers as well as people looking at the overall macro economy pretty happy. Our upstream inventories slowed down quite a bit. And these are wholesalers and people like that. And it's interesting because for most of the year, upstream is where a lot of the inventories are being held. Then it moved downstream starting at about the beginning of October. And really the middle of October is when we saw a ton of it move down towards retailers. And so right now downstream, we have very strong rates of growth for inventories, about 58. And what's interesting is we have statistically significantly higher rates of utilization for retailers. So downstream relative to upstream, significantly stronger rates of both warehousing utilization, 11 points higher, a 66 to a 55, and transportation utilization, also about 10 points higher, 67 to a 57 downstream. And so what that tells you is we saw a lot of movement in November, especially kind of second half of November. We saw a lot of movement in November at retailers. And I think that all of that movement, the question, I think the big question we've had this year over here at LMI headquarters, which is this room, was all this inventory coming in. Are we making a bet on Q4? And is that bet going to be correct? Because I think if you saw the rate the inventory came in through the ports, and we've been talking about this all summer, basically in fall, we had a ton of inventory coming in through the ports. And it really, this sort of big bulge was just sitting here at the wholesale level for a lot of the year. Were we going to have sales? And then you come into this weekend, Black Friday. I mean, you talk about 2019 being back. Black Friday is back, baby. Cyber Monday, we had $340 billion of sales in that 5-day period. It's a very seasonal looking, especially for our smaller respondents, by the way, a very seasonal looking holiday through the first week of it, and I think even Grinches like Tony who hate Christmas should be excited about the sales we saw last week, and what that may sort of be the forerunner of for sales through the end of Q4.
Hey, that does get me excited, and I only say that.
All right.
All I've done
this is going to be like what I want, Tony, is by the end of this, it's like when the Grinch's heart grows 3 sizes. That's my goal for you by the end of the show.
Because all I've done is kind of talk consumer, and they feel like they should be in a position that's maybe not as strong as it has been, but damn, they love to spend money and they're continuing to do it. I mean, my question to you would be, you look at like inventory cost, right? We've talked about inventory levels. Inventory costs went up pretty rapidly in from October to November. I mean, would that be a concern or just something to like pay attention to? Or, I mean,
No.
What's the
no? And so here's what I think that is. We talked about how warehousing utilization was higher downstream. Mm-hmm. Downstream warehousing and just downstream inventory storage tends to be more expensive because of where you're holding onto that inventory. So if you look at our upstream downstream split, upstream was 66 for holding costs. Downstream was 72. That's kind of the normal, I think, rate of movement that we would expect. The other thing, though, that I think is really important from this month, and it also speaks to why we're seeing this difference in inventory costs, is the difference between small versus large firms in November. So we don't talk about this breakdown as much, not just even on this show, but in the report we don't often focus on it. But it was almost the most interesting thing to me this month, and there's a couple reasons why. So every month we split out our respondents into firms with more than 1,000 employees or less than 1,000 employees. That's sort of our dividing line. And we have some respondents, I think, that have less than 100 employees. We have some respondents with 20,000. So we have a pretty wide spectrum, but we cut it at 1,000. And when we look at the difference between the big and the small firms, the smaller firms, their inventory level increase in November was 63.4. Big firms were at 50 flat. Okay. That tells us a couple things. First is that all of that inventory that came in early, that was a lot of larger firms moving those in for a couple reasons. One, they could, pay the money up front to get things in early. And then also they have the clout to force their, or maybe politely ask their suppliers, hey, hold on to this until we need it, basically. The smaller firms may not have that. And so we kind of see this split in the way, and we didn't really realize this was happening, I think, until this month, a split in the way these companies kind of came at it. The smaller firms, they're really using a pre-COVID strategy where let's build it up at the last second for Black Friday, very JIT, and we move things out. And that's reflected, by the way, in inventory costs for them, 4 points higher. Transportation capacity for them contracted in November, whereas it was positive for big firms. And transportation prices were about 10 points higher, 69.1 to 58.8 for our smaller firms. And so we see a lot of busyness for the small firms kind of at the last minute. The larger firms are taking more of the post-COVID strategy, which is not Black Friday, Black Fall. We bring things in early ahead of time so we know we have it. We extend our sales for a long time and things sort of move like that. We had been waiting to see if the small firms were going to recover because all year we had seen big firms more than 1,000 employees, really running ahead of those smaller respondents. And there's been some stuff I think even written after the election about how there's sort of two economies. There's the haves and the have-nots. For a long time this year, really all through 2024 and the last half of 2023, large firms or small firms were haves and have-nots. And now in November, we see the small firms joining the party. They are now sort of at least acting like haves, whether they are not. We don't, we'll have to see kind of how this continues going into 2025. But the fact that smaller firms came back online, I think should be good news for carriers, especially because it shows a more holistic sort of recovery going on in the freight market. I think the recovery had really been focused on the large firms through most of this year. And now we see the smaller firms coming up. I mean, they had a stronger transportation numbers across the board in November than their larger counterparts. And I think that that's something we're going to really keep our eye on in 2025 to see if this is sort of a temporary spike or if, the sort of market is back across our respondent base, which, as you guys know, SMEs are the lifeblood of the economy. More people work for small companies than for large companies. And so if we see those small companies coming back, that's pretty encouraging.
Yeah, I think that's a bullish signal, bare minimum, because they're showing up at all, right?
Right. Yeah.
Because we haven't really had them play in this space. So I want to talk a little bit about the forward-looking component here, because we are at the end of the year. So we got to talk about what's 2025 look like. And I know you have a forward-looking component of the LMI. I want to pull up the LMI capacity versus prices chart, because I think this is a decent jumping off point, especially for a lot of the transportation service providers, which there in the white line, you've got the prices component, and there in the orange line, you have the capacity component. As capacity comes down, prices go up. That's a nice little inverted relationship there. Looks like it's not exaggerated right now, but as we're talking about the economy being kind of in this middling ground of growth-ishness right now, for better, for worse. And but it looks like the transportation capacity is kind of hovering at a slow deterioration with prices in the same level. What does the forward-looking component say about this?
So capacity has been very resilient in this sort of recovery that's been going on. I mean, you can see, and this, you guys go back to about 20 here, and if you looked at the freight boom and bust before 20, the ones that happen in sort of 18 and 19, the slopes are not dissimilar when those two lines cross, and we call that a freight inversion. And so you can see it was really driven by that stimulus right there, that where it goes up hard in 2020, and then the invasion of Ukraine where it comes down in 2022. And unlike those sort of roller coaster moves that we had in 18 through 22, 24 has been a slow, steady recovery. And the reason is exactly what you just pointed out, and Tony mentioned it earlier in the show. Capacity has been very resilient. We have more capacity that was sort of built up because of what was going on during the huge boom period in 20 and 21. That's been able to come off the sidelines and absorb some of the new the business that comes in and sort of the expansion we've seen. And so because capacity keeps coming on, it stops prices from going up as much as maybe it would. Let me just take you through the last few months of capacity. I'll go back to June. 50, 50.9, 56.7, back down to 50, 50.8, and then this month 52.6. We've been around 50 about 3 times, and every time we hit it, we bounce back up. I keep thinking, okay, are we going to go back into contraction? And so far we haven't. And what's so fascinating is if you look at our future respondents, so we ask the people who take the survey, hey, next 12 months, where do you think this is going? They say transportation capacity holds at 53.5. Now, prices are expected to be up. It's 63 right now, 80.9 is the expectation going forward, and a lot of that is driven both upstream and downstream. Upstream 82, downstream 77 for prices, but we don't have the expectation that it will be this sort of runaway market like what we saw in 20 and 21, where capacity just can't keep up with demand, which then throws us into this sort of cycle where then a lot of times what happens is we overbuild capacity trying to catch up. And then when we have, whatever the next downturn is, that downturn hurts a little more. I mean, this is very, Isaac Newton-y, what goes up must come down. And so I think one of the things we're seeing with our respondents is the idea that we're having this slow, steady recovery. And hopefully what that means is that when we do cycle back down again, because you guys know we always do cycle back down, it's not such a steep drop like what we saw in 2022, which really sent this market sort of spitting out and 100-year-old companies like Yellow closing because of how fast we came back down.
Yeah, I mean, I think to me, I look at it, I think it's an interesting dynamic, right? I mean, you would think at some point we've been in this capacity market or oversupply market. You'd think you would at some point see, contraction in that market, and it just hasn't been the case. I mean, is there? To me, that just seems a little interesting when you look at it, and then the expectations for prices to go up without reducing, the level of supply.
So it's because we have a lot of flex capacity, and the other thing is, it's not consistent upstream and downstream.
Yeah.
Upstream is expecting contraction in capacity. The future number we got for upstream is 46.3. And I think that's anticipation of, like you said, flatbed season's coming back. And we're finally going to have a flatbed season without crazy interest rates, which I think sounds exciting for people. And so those big bulky things will move around. What's odd to us is, and it's probably one of the most surprising things we had in this month's report, is the future expectations downstream capacity is 23 points higher. It's 46 upstream. It's 69 downstream, which says that there's maybe a glut of capacity downstream with the retail level, maybe for last mile. Maybe we're anticipating, like you said, Tony, we've kind of spent our way through to the other side. I wouldn't be surprised. It seems like maybe retailers are concerned that there could be a consumer slowdown, whether that's reflective of things like tariffs or interest rates not moving as much as we hope they are, or whatever it is. That's a big change because if you looked at last month, downstream was expecting that capacity would be in the low 50s next year. And so now to be up at 69, I don't know if that's people worrying about, hey, are we going to have 60% tariffs to China? It seems like those 25% tariffs against Mexico maybe were like that was an idea we had for a week and that went away.
Talk about burying
but
the
I think
lead.
that's maybe part of it.
I mean, I feel like we landed on the most interesting thing there at the end, but we're the last 10 seconds of the show. So, you know,
well, come back in 2025,
Yeah.
everybody.
Let's go. I mean, big news.